Ajay Bagga is now joining us. Ajay, good afternoon. Can you just tell us about the markets? What is the sense that you get? You think DII flows are driving the market and no reason to believe that they will slow down?
Yeah, definitely, Pankaj. And today's price action has also been the arbitrage between the ADR and the domestic pricing of HDFC Bank. ADR at about $70 for two underlyings translates to about 1,600 rupees. And we have seen, a fierce buying, so much so that RBI had to put back the limitation today on FI for the not being allowed in a matter of few hours. So clearly that was the catalyst which took the markets on a gap up opening. And since then market is trying to consolidate. This breakout was expected, it was in about 9 days. And what we were really looking at was what would be the catalyst. Overall, I am positive on the markets on the way ahead, irrespective of what happens in the state election results. There will be a minor blip if the results are unfavorable to the central government, but that will get digested quite soon. The big factors which will drive this market will be the global situation, which is mildly negative, not very strongly negative, and I think it will turn out to be a little more positive than is being anticipated by the market. Second part is the domestic flows, which continue to be quite robust and which are quite retail in nature. So they are something that will stay on for the foreseeable future and will get increased. And the third is a recovering domestic macro. Despite all the demonetization, analyst commentary of it being a very slow recovery, we are seeing a more V-shaped recovery in key sectors, and the economy has shrugged it off. Fourth will be the monsoon and the GST, which is still some time away. I think that impact will come June, July. So right now, market is forming nicely to take out new highs. We saw that on Bank Nifty today, and I think Nifty will follow soon. I think in a few weeks' time, if not earlier, we should see new highs on this market.
Right. As far as HDFC Bank is concerned and the technical adjustment over there, so whatever is the FII number, that should not be looked as a change of trend, right? It could be a big buy number because of this opening up of limit.
Yeah, as I said, it becomes an urge, Pankaj. So, and then there are various ways to play it because of the size of HDFC Bank in Nifty as well as Bank Nifty. We normally see that players also take positions there if they can't buy HDFC Bank directly. And yesterday the ADR closed down about 0.9%. So clearly people released the positions in the ADR market and bought here to the extent the capacity was open. Overall, without saying a buy or sell on a particular stock, I think what it shows is quality Indian stocks. There is enough appetite even in this time in the FIIs, and that's very good even for the government disinvestment proposal. So we saw in the CPSE ETF the kind of oversubscription that was available, and it augurs well for the government's disinvestment initiatives going ahead. So long as you have quality managements which are tried and trusted by the market, I think you will attract more and more long-term foreign funding as we have seen today.
Right. Ajay, you have looked at domestic fund flows for really long. After demonetization, are you surprised by the flow and the picture that domestic markets are looking at?
Yeah, Pankaj, what has happened is say real estate is suffering. So some of the high beta, high risk sectors have seen an impact. Automobile, for example, which I would rate more as consumption and at the higher end as conspicuous consumption. Now in automobile, the commercial vehicles have gone slow. That is a leading indicator of the economy that people are hunkering down. but more the organized sectors have stronger, and you will see more and more of the economy counted under the organized sector. Otherwise, the GVA estimates and all, you had to really estimate the informal economy and the value added that each section of the informal economy was counting. A big portion of that will now come into the organized sector. That move has happened. Roughly with 65% of currency back in circulation, the economy is chugging along quite well. That shows a lot of the other currency was just hoarded, was just a store of value for ill-gotten wealth that was being hoarded by people of various segments. So overall, earnings have not been bad. Earnings have not been as bad as was anticipated. They have been pleasantly positive. There are a few global macro events like the US economy recovering, the European economy doing pretty well, Japanese economy doing well, and China continuing to grow at 6% plus. So all those are very positive factors. The recovery in commodity prices, even though we are consumers, but overall that leads to a lot more capex in the world, a lot more growth, and that has a second order effect on the Indian economy and the Indian market. So a lot better position than we were in November. We have already taken out the levels we were on November 8th market close. On that Tuesday, we have crossed that both in Nifty and Sensex as well as Bank Nifty. So markets have shrugged it off, Pankaj, and it has taken it in its stride. A small blip will come with the state election, so around March 6th, 7th, 8th, you could see a little, positions being reduced in this market. But DIIs have been keeping cash; they have not been allocating the entire cash. And if the result is favorable, then you could see the market surge ahead very strongly.
Right. Ajay, do you think that the faith of a lot of Indian fund managers has also increased, and that's why these flows may be sticky? If there is a decline, you may actually see more allocation coming in, because a lot of these fund managers have stuck with the same funds for really long. They've given performances. That's why investors have faith.
Yeah, definitely. The scale, you're talking of 6 lakh crores being assets under management of mutual funds in the equity side out of a 17 lakh crore corpus. And you're talking of about 25 lakh crore corpus on the insurance side. So now we have become reached some kind of a scale. Plus, what has happened is a lot of the demonetization cash which came into the banks has now moved to the mutual funds. Roughly about 3 lakh crores has gone into various debt mutual funds. Some portion of it will also find its way eventually into the equity mutual funds, whether through the SIP route or whether through the lump sum route. There has been quite normal profit booking as well. So it's not a one-way street. April to December, we've seen about 1 lakh crores of profit also being booked in the equity mutual funds. But overall, it's been a net inflow of about roughly 50,000 crores. So a gross inflow of 150,000 crores, which is a very big number. Overall, you're talking something like $22 billion in 9 months. So that gives a lot of support to this market, and that's also shown up in the FI ownership pattern falling for the first time in history. Otherwise, it used to be a pattern which was between 21 to 23% at any time, and it was holding around 23% for multiple years. And first time it has really gone down in the last 1 year, because DIIs are replacing the FIs as the lenders and the buyers of choice in this market.
As far as market valuations are concerned, you said that you're bullish on the market irrespective of domestic events. Do you believe that the worst in terms of earning cycles is behind? That's why in FY18 markets have started to discount good growth?
Yes, I think so. I think so. Finally, there's a turn happening, and GST will be positive. There will be hiccups. Some of the unorganized part of the economy will also go bust, will go bankrupt, or those models will go away. But the organized sector of the economy will benefit immensely over time, over a year, and markets being forward-looking are discounting that FY18 kind of a growth. And that's the kind of outlook that the market is having. Overall, what we are seeing is, even a mildly positive reaction on the state elections, and the government then comes in strongly with a lot more. It starts cantering towards the 2019 national elections. You're going to see a lot more spending from the government. Very strong reforms in terms of public sector listing on the stock markets that will deepen the markets, give more choice. And third, I think there'll be a huge focus on execution now. The last 2 years, the government is going to go into hyperdrive to drum up support. And right now, a lot of that, I think, will come together in March end. And then going into the GST, that will create a feel-good factor overall, even though there will be hiccups in the execution. But overall, it's a big reform. It's a very huge reform. And however ugly it might be in the beginning, it will turn out well. And that will be the confidence that the market will have. So unless there is a very poor monsoon, which could have a little impact or dampening impact, I see a lot of positives in this market, and that should take the market to lifetime highs in the next few weeks or a couple of months.
Ajay, what would be your top sector bets? Where would you, be overweight on? Let's talk about housing finance companies. They continue to be in a sweet spot, or maybe the overall NBFC space?
Yes, housing finance, even better than that, I would say private sector banks, including the emerging private sector banks, which have listed over the last 2 years. Go ahead and buy them and keep them for the longer term. Housing finance companies and the NBFCs, which have been outperforming, there are quite a few of them. I would say that's the top sector. That is an evergreen sector that will benefit from the broader economy as well as all the government reform process. As more money comes into the organized sector, they are going to get more and more scale. We already saw that with SBI and its associate banks merger. Now you're talking of a bank which is in the top 50. And it's a matter of time before the private sector banks also, there are more mergers and they just start taking on more size. So I think a lot of that will happen. MFIs will be taken over by banks. It's good for priority sector lending. HFCs also, there could be banks which would look at taking on HFCs. The reserve requirement is the big issue. But the benefits, especially with affordable housing now being in the infra sector and allowing banks to offset on their priority sector obligations, I think HFCs will become targets for banks also to take them over. HFCs, the micro housing finance companies, those will be very attractive for banks. Those could also see some merger acquisition activity picking up. So I would say if one sector you want to close your eyes and just buy for the next 1 year, 2 year, 3 year period, it will serve you very well, is the private sector bank and the NBFC. Public sector, I think there's a dichotomy. The smaller public sector banks will eventually get taken over. So there, if you want to play smart, you can nibble a bit and wait for them to be taken over. If it doesn't happen, then you suffer. Better bet would be just go and buy the top 5, 6 public sector banks. They will benefit from size. All the government reform process will benefit them. Hopefully, they will merge banks with them, at which point there will be value unlocking and you would see re-rating happening. So I think the top public sector banks could be looked at as well.
Right. Ajay, can you just talk to us about, in the private sector banks, the problem is that there are two kinds of banks. One is catering to retail and doing very well. One is catering to the corporate side, and, there are some issues of NPA. What would you bet on? Corporate banks doing much better going ahead from here? Because for the last 4-5 years, they've not done well.
Yeah, corporate banks, I think one more year of suffering is there, and more recognition of bad loans. So you're better off with the emerging banks, or with the consumer-focused banks, or the banks who have corporate books but who have managed to keep NPAs under control. I think those would be the three criteria. So first would be the consumer focus, especially the emerging banks, because you're going back in history 10, 15 years, you're getting a chance to buy one of the banks which has emerged now, say in the top 5 private sector banks, what you could have bought in the mid-90s or the early 2000s is what you're getting with the emerging private sector banks and the MFIs. Go buy those. Second would be the consumer-focused ones. Third, the corporate will take time, so you could have a 1 year of not going so fast as the others will grow. You could wait out some time, or if you want to invest, then invest it in 3-4 chunks. Don't invest it all together. Once a quarter, buy 1/4 of what you want to allocate to the corporate-focused private sector banks. So you're in the game, but you're not risking entire capital as well.
Right. Just a word on oil marketing companies. After the results, there were some concerns about this sector. But do you think they structurally continue to be one of the best plays?
They continue, and the merger activity there is expected April onwards. First, the small cap, mid cap oil companies owned by the government will get merged in. It's going to also go into the minerals and into the other mining areas. The government has a lot of companies there. So expect a lot of merger activity. It's already been announced in the engineering consultancy division, in the building construction companies owned by the government. So first time ever, the government is really trying to get in size and streamline these companies, bring in operational efficiencies, administrative structures. So the oil companies will also benefit from that. We will have probably 2, maximum 3 very big oil companies in India. Maybe it all dovetails into upstream gas and then into the marketing side. It could dovetail into 3 bubbles like that where the companies could be merged into. So going to be a very exciting area to be in. I would recommend investments, especially on the oil refining side. I think those are easy bets, and there's a lot going for them that will reward investors.
Ajay, thank you so much for taking out time for us. Always good to get a perspective.